Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Well, Eric, there is no shortage of information out on the internet that folks are reading about advisors, both sides of the coin. They either love annuities or they hate them, or at least they say they hate them.
Well, I was going to say, the word hate always seems really too strong.
A little strong, yeah.
But, I guess when you're the annuity guys, you're going to come off as being in the love category if we're going to put ourselves out there. So, first thing I went out there when I said, all right, love, hate, is that really the right way to go about this topic?
Yes.
And of course I find hundreds of articles. I hate annuities. And it tends to be the guys that usually don't offer annuities.
Well, or like some of the big investment firms. Yeah. And, one that comes to mind is Ken Fisher. You'll see him out on
You'll see his
internet.
ads everywhere.
Hates annuities. And yet, in reality, there's a war that's going on between the securities side of the industry and the insurance side of the industry, and both of them feel that they're trying to win those assets from folks.
And that's the key.
Yeah.
I think Ken has finally figured out that somebody's reaching in his pocket, pulling assets away because, well, maybe his dollars aren't guaranteed.
Yes.
And now he'll say that guarantees are what they're sold on, and that's a bait and switch that, you're buying for the guarantees, but you really don't get the guarantees.
Well, and if that were so, then folks should run from annuities. But the fact of the matter is that annuities have some wonderful contractual guarantees, and annuities have their place in a portfolio just like securities have their place. And it's each person's situation that's going to determine that right mix, that right balance. And that's so unfortunate that folks take, really, it's most of the time, Eric, it's just a marketing ploy to pull people one direction or the other.
It's a marketing ploy or a misunderstanding.
Yes,
I don't know how many times, and I don't want to pick on the bank employees, but because I used to run a credit union, so I know, basically people get trained on a certain product, and it's I always call it, somebody walks in your office in the bank and they have one product that they have to sell so many of, and
primarily a CD.
CDs, but they're getting more and more into the investment, the
annuities and the investments.
And so when I don't know how many times I've talked to somebody, they said, well, I just talked to so-and-so at the bank, and they wanted me to do this annuity.
Yes, I hear it too.
And the answer is, well, why did they want you? Well, I don't know. They said it was the best one for me. Well, how many do they offer?
Right.
Guess what? It's the best one because it's the only one.
Well, and you're right. It is easy to kind of hate something or give off a bad comment about something when you don't have access to it, when you haven't been trained on it.
Exactly. So, this one's the best one because it's the one I know and the one I sell.
Right.
That one's not so good because I don't know anything about it.
Right.
So, we hear those things, and that's where the misconceptions, the misunderstandings, people, and even I'm going to pick on the bank employees again. Sorry, bank employees. Sometimes they don't even know what they're selling. And so they're just spouting what they think they heard in the training, and they're paraphrasing. And the little twists of words in this industry can convey a whole different meaning.
Make a big difference. Yeah. And Eric, we're talking here about market-free annuities.
Yes.
And I think we should define that because one of the things about a market-free annuity is it really means it's free of market risk.
Right.
So there's another type of an annuity out there,
the
variable annuity, which is the only annuity that would not fall in this category of market free.
Because it is in the market.
Exactly. And there's many times if it's a variable annuity where an advisor is familiar with it, he has access to it, and he can collect an annual residual fee on it. It suddenly becomes the best answer.
Right.
And all of the other aspect of market-free annuities, which guarantee principal, let's make that the common denominator of a market-free annuity, that your principal can never go backwards.
Right. Because of investment performance, you are not at risk for loss due to investment performance.
Exactly.
Variable annuities could go down with investment performance.
Yes.
The best way of saying that, in my mind, when I try to explain it, is you're basically having an annuity wrapper around a mutual fund shell.
Right. And with that comes fees. You have much higher fees. Typically, the majority of market-free annuities actually have no fees or very, very small fees as compared to
the
variable
variables,
annuities.
which you're going to see a base fee of usually around 1%. Then you start to add riders and M&E charges, and when you're all said and done, and you've got what you think is the perfect annuity, it's costing you 3 to 4 to 5% a year.
Exactly.
And yeah, it's tough to get good market performance when you're giving up 5%. Even in down years.
Yes,
You thought you only lost 20%, well then you take fees and well it's a 25% loss. Well,
that's right.
But you've got a guarantee on the guaranteed minimum income benefit or death benefit.
Well, and we've talked about the folks that kind of hate the market-free annuities, and we've talked about the folks that really kind of like the variable annuities. But what about the folks that really love or like the market-free annuities? What's the motivation behind that?
Well, it could be lifetime income.
Yes.
And this is we're going to get criticized this, but the guarantees, of not going backwards. Now, I always don't want to say you can't oversell a product. And if someone sells you an indexed annuity with the potential growth of market-like performance,
that's going to get the same gains as the market, it's not going to happen.
It's oversold.
Yeah.
We always talk about beating the bank. And that's really where that slice is. These are safe, secure.
Exactly. You should expect some type of reasonable, moderate growth. Maybe just to put a number out there, maybe somewhere in that 4 to 5% range. Could be as high as 6. But if you're expecting that 7, 8, 9% that a good market would return, you're probably going to be very disappointed.
Right. But now we should, and this is, I guess if you look over the last 10 years, when you have these boom and bust periods, the nice thing with these, even on an index product, you're not losing money to the market when you have that 20% loss. So there are times, and we always point in the last few years, where the indexed annuities could beat market performance.
And they have beat market performance. So you just don't want to expect them to in a very robust economy and market.
We like it for retirees for the simple reason of you don't have the time to recover. Well, you're in retirement. You don't have 20 years to come back from a 20% loss sometimes. Because you're taking money out of your savings. It's what's retirement savings? Well, it's deferred spending. It's time to spend it now. So.
Now you need a plan. A plan that helps you to spend that money without feeling guilty, without running out of money, making all of those decisions that are going to carry you through 20 to 30 years of retirement. And that's what we love about annuities, is that it becomes the foundation for a portfolio. I call it like that rain or shine money, so that your basic expenses are going to be covered.
Covering your foundational income.
Yes.
And I think what the key aspect for us is annuities are a tool. They're one of the tools for your toolbox, your retirement toolbox.
So they're neither good nor bad. You don't have to love them or hate them. Use them correctly.
When used properly. It's like trying to drive a nail with a screwdriver. It's not going to work very well. You might get the job done, and it's going to be very painful on your fingers.
Well, and exactly. And Eric, I think we'd just like to tell folks this, that folks, this is not a time for trial and error. No. It's really get it done right the first time experience. So really work with experts that know what they're doing in positioning market-free annuities and balancing a portfolio.
That's right. You get to do retirement usually once, so do it right the first time.